Since the end of 2019, major Japanese and European banks have seen their share prices surging by 2 times to 6 times. India being one of the fastest growing major economies in the world, we would expect the same to have happened with major Indian banks as well. But it didn't. In fact, 3 of India's most respected private banks, HDFC Bank, Kotak Mahindra Bank, and Axis Bank, gave investors some of the weakest returns among the world's largest banks since 2019. Why is that? The answer has almost nothing to do with how well these banks ran their business, almost everything to do with the price you paid to own them. This video is based on the research and article by our very own Nishant Gopalakrishnan. In his article, he breaks down a fascinating comparison that a lot of Indian investors likely missed. We'll look at why banks from slow-growing, developed countries delivered far better stock returns than India's high-growth private banks over the last 6 years. And more importantly, what this teaches us about the single most powerful force in long-term investing, valuation. We'll keep it very simple as we try to help you understand why buying a great company at the wrong price can still leave you with a disappointing return. Let's start with the actual performance since 31st December 2019, just before the pandemic. If you had invested in MUFG, Japan's largest bank, your money would have grown nearly 6 times. If you had invested in SMFG, another big Japanese bank, your investment would have grown 5 times. Similarly, Deutsche Bank from Germany returned 374%. Share prices of other European banks such as UBS and Banco Santander surged more than 250%. Now look at share performance of India's top private banks. ICICI Bank did slightly better than other Indian banks at 162%, Axis Bank 65%, HDFC Bank 14%, Kotak Mahindra Bank just 15%. For context, the Sensex itself rose 87% in this period. So these banks, which were supposed to be the stars of India's growth story, underperformed even the broader stock market. Let's unpack why this happened. If you're a beginner in stock market, a couple of simple concepts may help you here. First, price to book ratio or PB ratio. A bank's book value is basically the net worth of the bank, its assets minus liabilities. The price to book ratio tells you how many times the market is willing to pay for a given net worth. If a bank has a book value of rupees 100 per share, the share price is 200 rupees, the PB is 2 times. If the PB is below 1 time, the stock is generally considered inexpensive. Second concept, return on equity or ROE. ROE measures how much profit a bank generates for every 100 rupee of book value. Here's an example. If a bank has 100 rupees of book value called equity, earns 15 rupees profit in a year, its ROE is 15%. If it earns only 8 rupees profit on the same 100 rupees, its return on equity is just 8%. A higher ROE is better. When a bank manages to raise its ROE over time, a market usually rewards it with higher share price. When ROE stays flat or falls, the share price often struggles, especially if the stock already is expensive to begin with. These two numbers, how expensive the stock was in 2019 and whether the bank's profitability improved or slipped afterwards, explain almost the entire difference in returns. What happened in 2019? In December 2019, most of the foreign banks in this comparison were trading at very low valuations, between 0.3 times and 1 time. The Indian private banks, on the other hand, were trading at a premium. HDFC Bank at 4.3 times, Kotak at 5.1 times, Axis Bank at 2.5 times, ICICI at 3 times. Back then, these Indian banks had a loan growth rate from mid-teens to 20%, far higher than single-digit growth rate that the global banks had. In addition, low global interest rates and high free floats in these stocks made them attractive to foreign institutional investors. Given India's expanding financial services market, investors were paying a high price because they expected these banks would continue to grow fast and stay highly profitable. Here's where the story gets interesting. The Japanese and European banks were inexpensive to begin with. They were undervalued in 2019. After the pandemic, the profitability and ROE for many of these institutions rose, making them more attractive to investors. When you buy something at a lower price and its performance gets better, the share price tends to go up quickly. That is exactly what happened. Now look at the Indian banks. It's not that their businesses suffered. Most continued to grow loans and profits, but they could not deliver the high and rising returns on equity that investors had already priced in when the stocks were expensive in 2019. HDFC Bank and Kotak saw their ROE come under pressure. Axis improved its profitability, but concerns about unsecured loans limited how much the market was willing to re-rate their stock. ICICI was the relative outperformer. It roughly doubled its ROE to around 16%, which is why it delivered better returns than the other three. At the same time, foreign institutional investors who held large stakes in these banks reduced their holdings as global interest rates rose and funds moved to other themes such as AI. As a result, the high valuations of Indian banks came down. The PB of HDFC Bank and Kotak Mahindra Bank is just half of what it used to be before the pandemic, from about 4.3 times and 5.1 times to 1.8 times and 2.1 times respectively. ICICI Bank's PB fell the least from 3 times to 2.7 times. In contrast, PB ratio of all global banks in comparison has risen. To understand what this really means for investors, I spoke with Nishant Gopalakrishnan, the author of this analysis. Nishant, what was the key takeaway for you when you put these numbers together?
Well, when I looked at the underperformance of HDFC Bank and Kotak Mahindra Bank, I was curious to know how globally banks had performed. There is this huge, massive delta in returns as you may have seen in the charts. I did a bit of digging around to find out that the difference actually lies in valuation. You were right to point out that before COVID, the multiples were quite high for our Indian banks, because at that time the interest rates were low and our private banks were giving mid-teens to 20% loan growth and profit growth. They also kind of, to an extent, had a scarcity premium in the sense that while their PSU counterparts were dealing with asset quality issues of their own, HDFC Bank and Kotak Mahindra Bank and other private banks were only focused on growth and they had good market share in retail. Cut to today, HDFC and Kotak have seen valuation derating as they have not been able to keep up the ROE they had pre-COVID for various reasons. HDFC's margins are under pressure as it took over the high-yield bonds of erstwhile HDFC Limited, with which it merged. Kotak was the king of CASA balances then at around 55% CASA ratio. Now its CASA ratio languishes at 43%. Kotak also had to deal with the microfinance issue briefly. PSU banks have upped their game now that their asset quality issues are largely behind. They have also upped their game when it comes to technology and digital adoption. So the scarcity premium that our private banks had pre-COVID has vanished, and coupled with ROE declining, that has reflected in their multiples. In hindsight, the 4 to 5 times price to book multiples do not seem to have factored in these kinds of eventualities.
Now that the high valuations of these Indian private banks have come down, what will you be watching most closely going forward?
You see, multiples have indeed been beaten down, and in my view, they have bottomed out. So any improvement and sustenance of metrics should result in some upward re-rating. But the fact that with mutual funds, deposits have become very hard to mobilize for banks, and it reflects in the lower margins banks are left with today. This especially when credit demand is stronger than deposit growth over a few quarters now. So naturally, banks which have easier access to retail granular deposits and high CASA ratio will come to have some edge. This is something I'll be closely watching going forward.
This comparison teaches a powerful truth. It is not enough for a company to be doing good. The price you pay matters enormously. When you buy stocks of excellent companies at very high valuations, even solid performance can produce mediocre returns. When you buy average or improving businesses at low valuations, even modest improvement can generate good returns. India's economic growth is real. The banks were and still are doing well, but the market had already valued them in 2019 for an extraordinary future. When the reality turned out to be merely very good instead of extraordinary, the share valuations paid the price. The reverse happened with many global banks. The market had pessimism baked in. When things got even only a little better, the stocks soared. So the next time someone tells you, this is a great company, just buy it, the most important question you should be asking is, at what price? Valuation is not a side detail. In the long run, it is often the difference between ordinary and extraordinary results. If you found this useful, do share our video with others who follow the banking sector. You can read Nishant's full analysis on the Hindu Business Line website and let us know your thoughts in the comment section below. Thank you for watching.